This chart shows the 10-year Japanese Treasury yield. It's not the price of a cryptocurrency or the decline of meme stocks, because it is far more crucial than all of those risky investments. This yield provides a window into the Japanese economy. Therefore, it is exceedingly risky when a chart showing the health of a nation's economy behaves somewhat like a meme stock. Another event of 2022 is causing havoc in the financial markets. What was once a safe haven currency recognized throughout the world has now become another desolate currency. Yes, we are referring to the Japanese yen, which has been steadily losing value throughout this year. This week, the Japanese yen plummeted to levels last seen early in 2022 against the US dollar. You're horribly mistaken if you believe that this is a problem that only affects Japan from where you're sitting. As much as the free fall of the yen causes issues for the land of the rising sun, it also affects the rest of the world, especially the United States. You might ask how? Well, hold on as we go into great length regarding the falling Japanese yen. Hey, welcome to Stock Market Mate. Today we'll talk about Japan's worst currency crisis. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. What is causing a weak yen? It's one thing for the value of the currency to experience a slight decline, but quite another when it drops to levels that haven't been experienced in 20 years. That definitely causes concern, particularly in light of the yen's position as the third most traded currency internationally. It started at 115 in 2022, and it's currently close to 134 per dollar. The dollar has increased by $16 so far this year, and we can only assume that it will continue to rise. All we can say is that it appears that the yen is headed for rougher waters right now. But why is the yen so weak still remains an open question. While the widening interest rate between Japan and other countries are the main cause of the weakness, the difference between interest rates in Japan and those paid elsewhere is expanding dramatically. How does this matter? Let's explain then. You see, major global powers, led by the US Federal Reserve, have been aggressively hiking rates to control surging inflation due to various inflation rates in different countries. However, Japan hasn't. This is due to the fact that there is seldom any inflation in Japan, and as a result, the Bank of Japan has maintained its lax monetary approach. As a result, there is a 279 basis point difference in the yields on Japan 10-year government bonds compared to those in the US. Simply put, this is astronomical. In addition, the Federal Reserve plans to raise interest rates by 0.5 percentage points at its upcoming meeting, putting them on track to reach 3% by the end of the year. It follows that the gap will continue to widen. The Bank of Japan stayed firm once again, holding rates unchanged and even doubling down on the yield curve, suggesting a commitment to easing despite the plight of the yen, said economist Craig Botham of Pantheon Macroeconomics. The Bank of Japan is in an undesirable situation as a result of all these acts. As you can see, the central bank maintained rates and promised to set a 0.25% yield cap on 10-year treasury bonds. This revelation merely led to a further decline in the value of the yen because this rate is nothing in comparison to what the United States is providing. Effects of a weak yen on the US and the rest of the world. What does the decline of the yen therefore mean? For additional markets as well as only the US. Let's get started. It's safe to argue that the effects we have already seen and those we will experience are somewhat different. On the one hand, investors engaging in so-called carry trades have traditionally preferred the yen as their currency of choice. In order to invest in higher-yielding currencies like US or Canadian dollars, this means borrowing money in a low-yielding currency like the yen. So the yen has worked out perfectly for the strategy as its cap yield of 0.25%. Many people borrow money in yen and make investments in equal amounts of dollars from the US, Australia, and Canada. According to concrete data, people who did this would have produced little over 13% over the first few months of the year. That is a sizable gain, especially when taken into account. It becomes quite intriguing when discussing the direct effects on the United States. Around this time this year, the Federal Reserve is expected to start reducing the size of its enormous bond buying program. In an intriguing turn of events, the central bank is relying on investors like Japanese institutions, the largest foreign purchasers of US Treasury securities, to step in and assist in absorbing the increased supply of Treasury securities in the market. At the current price, though, it's possible that this won't go as smoothly as anticipated. This is because the Japanese demand for treasuries may be impacted by the yen's direction. You might ask, how? Let us enlighten you. You see, if the yen declines, Japanese investors who hold assets denominated in dollars will have to pay more to insure against currency risk, decreasing their returns. The generous US yields should theoretically keep Japanese investors interested in the treasury. The 10-year Japanese government bond offers a yield of only 0.25%, compared to the US Treasury's yield of 2.9%. The downside is that, since hedging has become so pricey, the additional yield that a Japanese investor would receive from holding treasuries rather than Japanese government bonds has almost completely vanished. According to Daisuke Karakama, chief market economist at Mizuho Bank, Japanese institutions are likely to concentrate their portfolios more on ultra-long-term Japanese government bonds rather than US assets, because they are afraid of the weak Japanese yen and expensive US stocks going downhill. According to data, Japanese investors have been reducing their holdings of foreign bonds. According to the Japanese Ministry of Finance, they have been net sellers of foreign bonds in all but 1 month since November, selling a net of 2.36 trillion yen, or the equivalent of $18.4 billion in overseas bonds, according to the Wall Street Journal. Given that bond investors have already suffered significant losses this year, a reduction in bond purchases would come at a particularly bad moment for their American counterparts. If Japanese investors with a high risk tolerance opt to continue in the treasury market, they may avoid paying higher hedging fees by foregoing and taking out currency risk insurance. However, there are drawbacks to this. One's yield advantage might completely disappear in a matter of days if the yen were to bounce back and suddenly surge versus the dollar. This is a factor in the uneasiness among investors. The yen's rapid decline and uncertainties surrounding policymaker initiatives make the situation far more volatile than it should be. This raises a question for us. When conditions are this poor, the question arises, is the Japanese government blind to what's taking place? What should we concentrate on? What should we focus on considering the weak yen? When the Asian financial crisis triggered a sudden flight of capital from the region in 1998, Japan acted to stabilize its currency. Tokyo had previously taken action to stop yen declines from 1991 through 1992. These are unique times and extremes, as you can see. It would be foolish to rely on them and treat them as the standard rather than the exception. The expense of government intervention in these situations is often too much for them to bear. Is there any benefit to having a weak yen? Surprisingly, Japan's weak yen has some advantages. In comparison to the Chinese yuan, the yen has fallen back to previous lows not seen in 7 years. In addition, it is currently at a fresh multi-year low versus the Korean won and the Taiwanese dollar, which should help Japan's growing trade deficit. The yen benefits from trade more than it is less expensive. Some claim that currency weakness is essential for Japan's economy to sustain its competitiveness as a reliable source of supply chain diversification. John Vail, the chief global strategist at Nikko Asset Management, is one such person. The yen's depreciation also increases the appeal of its stock market to international investors who think it is undervalued in comparison to the European and American stock markets. In 2022, Japanese stocks have outpaced their competitors. Nevertheless, they're still declining as investors worldwide sell riskier assets. The last and possibly most important question is, if the government doesn't step in to stop the yen from falling out of favor, what else could? What could stop the yen from free-falling? It's difficult to say. But the Bank of Japan's dovish stance may change if growth prospects significantly improve as the nation reopens its borders following COVID. For the first time in 7 years, Japan's core consumers' prices in April were 2.1% higher than they were a year ago, reaching the Bank of Japan's 2% inflation target. The yen's decline might come to an end, according to Francesca Fornassari, head of currency solutions at Inside Investments, if the Bank of Japan adopts a more hawkish stance. Any indication that interest rates outside of Japan are at their peak could also spark a relief rally, although future markets expect the US rates to peak at 3.5% in mid-2023. There are currently no indications that this will happen. We anticipate that in 2022, just like many other things, we will have to wait and watch what happens. That's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!